Tesla reported earnings last week and the stock dropped around 12%, giving the company a market value of $640 billion. With $29 billion of cash on the balance sheet and $5 billion of debt, the enterprise value is $616 billion. Not long before this announcement, some people were talking up the prospect of Tesla becoming a $10 trillion company, helped by a rollout of humanoid bots and artificial intelligence. Those predictions now look poorly timed because this was a disappointing earnings report from Tesla. Automotive revenues rose less than 2% year over year, and profit margins have tanked. Gross margin in the latest quarter was 17.6%, down from 24% 1 year ago, and operating margins fell 47% to 8.2%. That's now lower than legacy automaker Toyota Motors. Company outlook was also disappointing. Tesla said that vehicle growth would slow again this year, and on the company conference call, Elon Musk said that without tariffs, Chinese manufacturers would pretty much demolish most other car companies in the world. Longtime Tesla bull Dan Ives called the Tesla call a train wreck. Looking at the valuation also causes concern. Tesla earned $96 billion of revenue last year and $15 billion of net income. But $5.9 billion of that was due to a one-time tax benefit. Account for that benefit and Tesla's valuation looks a lot less appealing. Enterprise value to free cash flow, which is an important metric for capital-intensive companies, is extremely high at 141. And yet, despite the discouraging quarter, 2023 was still a successful year for Tesla. Long-term trends are still intact, and the Model Y became the best-selling vehicle of any kind. Self-driving continues to improve, and there are strong gains in Tesla's other segments. Energy generation and storage revenue, for example, grew by 54% to $6 billion. With the company putting a record amount of capital into R&D, AI and humanoid robots may well play a part in the company's future. Let's assume Tesla can grow its automotive revenue by 12% a year for the next 5 years while growing its energy and services segments by 25% per year. In that scenario, Tesla's total revenues would reach $190 billion in 5 years' time. Give the automotive segment a 10% net income margin and the other segments a 20% margin, and Tesla could be producing $24 billion of net income in 5 years' time. A 35 times multiple then takes the valuation to $840 billion, which works out to an investment return under 6% per year. That doesn't account for share dilution, which would be partially offset by Tesla's cash balance. Overall, the problem with Tesla isn't the business, it's the valuation and the low margins that come from automobile manufacturing. At some point, Tesla may present a good buying opportunity, but right now momentum sits firmly with the bears. But these are my personal opinions, not financial advice, and I hold no position in Tesla's stock. For more investing videos, make sure to visit my website 3minutebreakdowns.com. Thank you for watching.